Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we'll go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics and sectors, looking for investment opportunities, sharing those opportunities with everyone in the community. I do that through midweek updates on Wednesdays, and we do question and answer sessions through a Zoom call on the weekend. So if you have questions or you want to know about a company and get my opinion on it, then yes, you can sign up, ask me the question, and I will answer your question. Can't make the Zoom call, that's no big deal. They're all recorded and they are posted to the website. Special is a coupon code, 50% off the first month only on a monthly membership, and a $100 discount on the yearly membership if you'd like to sign up either directly to the yearly or swap from the monthly to yearly membership. Starting off with Toll Brothers, Lennar Corp, and DR Horton, Homebuilders. Homebuilders. So down below a couple of posts, there's people who are very, very bearish on the real estate market. They're like perma bears. And they think that the housing market is going to crash. Usually, what you see is the market itself will start to price home builders lower before the big blowout crash. So I use home builders and I just look at a variety of large home builders. In this case, there's three there to see what they're doing, to see what the market is positioning in the home builders. So if we were going to have a big crash like 2008, you can see the home builders turned in 2005. We started to uh, basically get a bunch of inventory, not just new homes, but existing home inventory as well. And you can see home builders turned and went lower throughout that time frame. They turned in 2005. The problem didn't come till 2008. Now, when we look at the chart here, we have a massive breakout, massive breakout right at 2022-21. So 21, 22's, or 22's the pullback. 23, 24, we continue to head higher. We are in an uptrend with a massive breakout. This does not look bearish. There's no topping pattern. There's nothing rolling over, at least at this time. So that looks good to me for Toll Brothers. Same thing with Lennar Corp. Lennar Corp had a pretty rough 1980s into the bottom of the bear market in 1991. We had a huge move higher and broke that trend of the 80s and early 90s to the upside. From there, we went from early mid 90s, 92, 92 all the way to the peak of 2005. 92 to the peak of 2005. And you know what? We just broke that breakout in 2021. 2020, 2021 for Lennar. That's a big move higher. We did a retest on top of it, and we've been heading higher ever since. Moving on over here, this is DR Horton. We had another big sideways chop from 2005. Notice they all peaked in 2005, had a pretty big rollover to the bottom of 2008-9. Then we had a nice little consolidation here, and then we're moving higher and higher and higher, and we are in an uptrend. We've broken through this last kind of resistance. We did a retest and heading on up. So by looking at this, I cannot tell that we are going to get this big crash. And what the market is telling me is that, nope, we are going to go higher. Higher, not lower, higher. So that's what I see in the charts there. This is XHB, home builders heading higher. You can see 1, 2, 3, 4, 5, 6, 7, and then a potential break higher at some point here. Could we cycle back down? I don't think so. That's my guess. Otherwise, we'd see the home builders. So that's looking good, and that's been heading higher here. So could a lowering of interest rates push home builders higher? I think that's what the market is pricing in. I think. Now, that's me interpreting what the market thinks. I don't know if that's for sure. Maybe that's the case, maybe it isn't. Maybe they're just bullish because we are short homes, period, flat out. We're in an expansion phase. I can't believe so many people are bearish and we're in an expansion phase of real estate. Like, do you know how bad you have to be at real estate to not even understand that? That is crazy. Here is the year-to-date returns of the world's largest markets. Greece and Poland are crushing it. Look at the year-to-date returns in these. Do you know what they're all, you know what's driving this? A weaker dollar. A weaker dollar is money starting to flood out all over the place into international markets and emerging markets because the United States market, I think, will underperform. Even though they're printing money and probably buying stock for all I know, this is where you can see outperformance is when you do the ratio of international equities versus dollar denominated equities. So Greece is number one at 65%. We got Brazil here, 31. That's pretty good. I think these are all going to start to break out. Some of them, like these emerging markets, EWZ, and what else is up here? No, Chile. I think Chile is starting to break out too, but those look good. Coming down, reserve the right to be 100% wrong, strategy over predictions. Yeah, I agree with that. Totally. Steve is 100% right on strategy over predictions. Um, you're not going to be right on every single call that you make. You're not going to be right on every single pick that someone puts in the portfolio. That's why you position size and allocate across different sectors and different companies. Your strategy is what allows you to win. And my strategy, I can sum it up real quick. My strategy is to allocate a certain percent of money into each position, spread across positions, which could be ETFs or individual companies, or commodities themselves and precious metals. Spread it across, look at the risk reward opportunity at that moment, and then decide on what to allocate to that position size. And it usually spans across 6, 7, 8, 9, 10 different ideas. And I accumulate those ideas when they are incredibly cheap. So there's gigantic asymmetry. The asymmetry is what carries the portfolio higher. It's not, I want to get the most percent. When I allocate money, I want to have a high percentage of being right, but the asymmetry is more important than being, say, 85% right versus 80% right. You can be more right, but make less money. The asymmetry, which I give up a little bit of my percent of being right for the large asymmetric opportunity. So if I'd rather hold and go for companies that can do a 100-bagger than ones that can only do a 5-bagger. Because I can be wrong on some of the companies and still outperform a larger, less risky company. And I could be less successful in my companies that I select. So my percent wins can be lower as long as I have a few that can just have absolute ridiculous asymmetry. The richest people in the world, I'll tell you how they got so rich. Not all of them, but a lot of them. From an investor standpoint, is they allocated capital to companies and then they held them for very long times, like time frame 20, 30, 40 years. And then they just absolutely had massive outperformance in very few of their holdings, but they just continued to hold them. So some of them ended up being 3,000 baggers. 10,000 baggers. 10,000, not percent, baggers. So if you had any money in it, you made tons of money. And that goes for some of the richest people, or say some of the richest investors um, in India, in America. It's all over the place. In China, it's people who took positions pretty early in a company and then held them for a very long time throughout the business cycle, the big business cycle. I'm not talking like business cycle that people are thinking like it cycles up and down, you get recessions. I'm talking about the business itself and the cycle of products that goes through the market and holds it all the way through. Like buying Tencent when it was nothing. Buying Coca-Cola for Buffett would be an example, or buying MasterCard when it went public and you're just riding it the entire way. That's how a lot of people made their money. It's not playing short-term market movements. Not how they made it. Don Johnson. So here's the post that I was basically posting against. He says the 10-year has been falling, but the mortgage people that are posting application improvements for X weeks straight. Crowd has gone silent. Prices are the problem, not rates. No, it's not. Rates have a much, much, much larger impact on affordability than prices do. I mean, it is astronomical, the difference of affordability between a 10% mortgage rate and a 5% mortgage rate versus a 2.5% mortgage rate. Astronomical differences. Price could be a problem, but rates are a much larger problem, in my opinion. Now, this is what he says. Guess what rate cuts would do to prices? He says another TikTok DA. Yeah, well, let's see what happens to assets when rates get cut and the melt up implodes the market. So I'm in the camp that Jason is right. I am not in the camp that Don's right. I think that if they lower interest rates, it will have a positive impact on home prices going up. It'll be inventories will come down, and it may take a little bit of time. It may not happen with a small rate movement lower. It may not spark the home prices immediately. And people think that this stuff happens so quickly. It doesn't. It doesn't. Says the supply gain people like that goofy Logan guy are also very silent about the alleged undersupply of housing that would put a floor under prices. Everybody, guys, I don't know what it is, but bears don't make money. They don't make money. And these arguments are not that great. If we were in a bear market, you would see home builders roll over. But the smartest people in the market that are allocating copious amounts of money piling into home builders. But these guys on Twitter, but they're right. They're right, but the guys piling into Toll Brothers and D.R. Horton, I don't know if you guys know this, but Warren Buffett is all sorts of loaded up in home builders right now. Think he's wrong, or do you think these guys that are perma bears are wrong? I don't know. Rafi says, "Oh no, gold might break below $3,600 an ounce. It's over, guys. The Keynesians are right. The dollar is money, and it will last forever. Just like every other fiat currency ever created, facts are facts." And obviously he's joking. Guys, tell me how gold's going to resolve itself lower. Tell me a scenario where gold's going to go to $2,000 an ounce or $3,000 an ounce. Maybe 3,000, but say 2,000. Tell me a scenario where that happens. Tell me a scenario where we break out of a consolidation, which we just did, where we go to $4,000 an ounce. Yeah, pretty much. Probably what's going to happen. But everyone is so afraid. They're all calling for pullbacks. Oh, it's overextended. The relative strength indicator is too high. Oh, look at this, guys. In a bull market, we're going to peg the damn RSI, and we're going to peg it up there for a long time. That's what happens in bull markets. Now, I don't know if we're going to get pullback in gold right now. Does it really matter? We're in a bull market, guys. We are in a bull market. Stop being bearish. That's it. That's all I ask. We're in an expansion phase of real estate, and people can't even figure that out. They can't even figure that out. And some of these guys proclaim to be real estate experts. Jesus. I mean, you got to be riding the short bus and not even understand that we're in an expansion phase of real estate. Go listen to just a couple of Homebuilder earnings calls. Yes, it may not be rosy and cherry for the entire expansion phase. And yes, maybe the mid-cycle wobble, and maybe these guys don't even know that a mid-cycle wobble exists. But my Lord, if you're in an expansion phase, at least recognize that you're expanding and that everything isn't falling off the face of the earth. You fall off the face of the earth when your expansion phase, your housing starts dive below the average. And then real estate construction workers start getting laid off in mass. That's the recession. That's the slowdown. But no, let's go stare at home prices and every single little wiggle that we've got. Eric Nettle says U.S. oil inventory levels are quickly normalizing, with the deficit to pre-COVID levels hitting the lowest level in 10 months, which is bearish. We think inventory builds are about to become much more observable in the coming weeks, cause for pause. This is U.S. commercial crude inventory excluding SPR, very low level, still at a very low level. And this is the U.S. crude oil inventory deficits to the 4-year. It's been coming up some. So our deficits are getting less, is the way that I read this. So he calls it normalizing. Now, here's the thing. Markets are forward-looking. This is backward-looking. And this is the big difficult part for a lot of people to understand where I used to work. They always wanted to look at these numbers looking backwards. And I'm like, that's fine. You can track that and you can see how we're doing, but that's not how you get better. You don't get better by looking backwards at some of these metrics. What you need to understand is, what do you want to get better at? And then how do you get better at it? That's the key factor. So when you look at some of these are all backwards facing. What impacts oil demand? What impacts oil supply? And what are those two things doing? In my opinion, demand for oil is, I'm going to make this super simple. It's money creation. M2 money supply is demand for oil, period. Anyone who argues different, go look at history. M2 going up, it's going up. It's going up rapidly, in fact. Then, what's the supply side look like? Are we going to get a whole bunch of supply? In my opinion, no. I don't think so. Now, a lot of people are hanging their hat on OPEC increasing production. Well, their quotas could, but are they actually exporting more oil? I don't know. We have to watch and see that. I think that they're going to print a bunch more money. I think the demand's going to go way up, and then we'll see how the supply responds. We're getting rig count dropping in shale oil. So shale in America, rigs are dropping all over the place. So I think shale is going to roll over here probably next 6 months or something, and then we'll see what it looks like at that time. Housing data shows sellers now exceed buyers by over 500,000, marking the largest imbalance ever recorded in the market per Redfin. Okay, so that's the data, and then people read this, and then they get super bearish. And then I go back to the home builders. Go back to the home builders. What are they doing? Are they going down or are they going up? They are looking forward at what is coming. This is looking backwards at the current conditions. So perhaps some of these guys know that we are going to lower interest rates, and perhaps they're getting bullish because of the lowering of interest rates. We'll see. Maybe there's programs coming in government with home buying help. I don't know what it is. But markets are not positioning for what this data is saying here. They're not taking action on it. The entire planet's silver mining output is 41 hours of the American US government spending. Have a nice day. I didn't know that, but that is pretty crazy thinking of it in that respect. Strong ISM non-manufacturing orders, but it's usually a lagging indicator, not leading. It tells you that retail sales were fine for the past 6 months, that they've gone up and they're not bad. Okay, that's a little more bullish at least. Rock Bottom Entry says the US dollar index is about to lose a 14-year uptrend support. The last time a similar breakdown occurred was in the early 2000s, igniting a commodity supercycle. We're on the edge of such a move. Life-changing returns are within reach for astute investors. Yeah, and that could happen. I see a bottom here where we could head higher for a period of time. That is possible because we haven't broken through yet. We've got coal to gas, dry bulk, and LNG. We've got the sector last year turned 267 or 276 million tons of coal, equivalent to almost a year of European coal use, into chemicals, oil and gas, according to the China National Petroleum and Chemical Planning Institute. If all planned projects proceed, the industry would roughly double over the next 5 years, according to Sinolink Securities. The most projects producing synthetic natural gas or liquid fuels. So what they're doing is they're converting coal to gas, natural gas. So that's also something that people don't think about. You can convert coal into gas. U.S. oil giant ConocoPhillips will lay off up to 25% of its global workforce. Yeah, that's a huge bull market. We're in oil. No, it's bottoming. We're towards the bottom of all this, and this is what you see at bottoms. You see layoffs and stuff like that occurring. Pareto, VLCC momentum is picking up. VLCC is tankers, oil tankers. With more activity and cargoes booked a few points higher yesterday, FFAs also strong, with further gains after the OPEC Plus rumor of further hikes being likely. It will pick up. If they do hike in hike production, then VLCC is going to do well. This is why natural gas has quickly gone from the bridge fuel to the fuel of the future. The U.S. power demand growth is rapidly escalating. How will they meet it? More natural gas is required to feed growing electricity demand. Electrification of heating and transport, data centers, and AI-driven future will create unprecedented growth in power demand. The projections, rapid increase in electricity demand, so 2025 to 2040 is going to be an increase of 31%, driven by emergence of large load data centers and EV growth. That's what's coming. And we're playing this trend here with coal and natural gas. Great futures AM update. We've got dry bulk, Capesize flat, Panamax up 4%. That's looking good. Tankers, VLCC is up 2%, Suezmax flat. These are just different size tankers. James Lavish says, good evening. The U.S. added $500 billion of federal debt in the last 30 days. Have a good night, or have a great night. That is pretty crazy. Anas says, the oil market outlook is brighter than current sentiment. The decision by the Group of 8 on Sunday is uncertain. If they unwind the 1.6 million barrel per day voluntary cuts starting in October, as some media report, bearishness will persist unless a major political event occurs. Despite the net increase being way lower than the 1.6 million barrels per day due to maxed out production in many countries, perception and credibility matter. The market will view the full 1.6 million barrels per day as an addition. Producers like Iraq and Kazakhstan will learn a lesson they should have grasped earlier. Again, Conoco's 25% layoffs aren't just cost discipline. They expose shale's broken math. Rising costs, flat output, falling prices. And what do you need to do then? You need to preserve capital, cut costs. So they're doing layoffs. We've peaked. Brady says that is a 14-year rounded bottom in the making. Going to climb up the right side. This means it is one more chart showing that the commodities bull market is entering a new phase. Metals and mining sector is breaking out hugely versus the stock market. And do note that the metals and mining sector has outperformed the stock market for 5 years now already, since the commodity bull market started. The outperformance is now about to accelerate with this huge breakout below. The glorious commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. As said now for 5 years, do not miss it. So this is metals and mining ETF versus the stock market. And there's the breakout there. That is a big deal. And guys, people are so worried about the short term here. This is a long-term breakout. Let it go. You need to accumulate shares and just ride the damn thing. Ride it on up. Jordan Roy says, the root cause of every problem in this country is the fiat monetary system. Totally agree with that. Gold's breakout to new all-time highs in 2024 and silver's coming breakout to new all-time highs will lead to parabolic moves over the years ahead and an eventual cleansing of this fraudulent system. What is a fraudulent system? We are supposed to have gold and silver as money per our Constitution. But what do we have? Garbage, toilet paper, fiat currency that isn't even worth wiping your butt with. Why? Because you don't want to wipe your butt with dollars. It's not a good thing. But that's what it's going to turn into. Analysts warn of a looming oversupply, yet OPEC Plus sees another hike. So who really knows oil better, the analysts or the producers? I choose the producers every day. What is he saying there? Analysts are all saying, oh, we're going to get this huge oversupply. OPEC doesn't produce into oversupply. Think of it that way. So the producers know what's coming. It's probably demand. Our crude storage estimates for this week's report, HFI Research is estimating a draw of 2.66 million barrels. We have reached throw a dart territory in the junior mining space. Okay, I read that last time. So that's where we're going to end it. That's what we've got for today. So give me a thumb up for the content, subscribe to the channel, subscribe to the website, specials, the coupon code. And that's all I've got for today. We do have a Q&A session coming up Sunday at 5 p.m. Mountain Time. Reminder. That's all I've got. We'll catch you next time, guys. See ya.